This is Mark Sobel, U.S. Chair OMFIF. Today, I'm delighted to be joined by three friends and colleagues for a discussion of global market issues. I'm looking forward to a highly lively discussion with Robin Brooks, Chief Economist at the Institute for International Finance and formerly a Managing Director of Goldman Sachs's FX Strategy team, Bob Savage, Head of FX Sales Americas at Bank New York Mellon, a veteran of FX markets, including with Goldman Sachs and others. And John Fagan. John is a partner with Markets Policy Partners, and like the others on today's panel, one of the best market analysts I know. He was director of the U.S. Treasury's Markets Room for several years, and prior to that, a longtime senior macro strategist for Discovery Capital Management, primarily responsible for Asian equity indices, foreign exchange, and rates markets. And he somehow wandered into this career by getting a degree in securities law.
Some fancy footwork involved there.
I have quite a few financial market themes that I'm going to ask the panelists about for perhaps the first half of this discussion. And we'll do so in a lightning round fashion. I expect the answers will give us plenty of food for thought. I'll then turn it over to the audience. The audience can submit questions at the Q&A function, and depending on how things develop, I'll either call on the audience person directly to pose a question, or I'll intermediate. So let's get into it. Let me start with Robin. So the baseline view is that the US grows like gangbusters in second and third quarter. It then begins reverting back to trend in 2022, 2023. Headline inflation jumps very solidly. This quarter, who knows, 3-4% range on base effects and supply constraints, but then begins reverting back. Meanwhile, core measures such as PCE may also rise, but that is seen as transitory as well. But last week's employment report and this week's CPI report have stirred and shaken the baseline. So do you still buy the baseline?
Hey, Mark. So thank you to OMFIF for having me here. And of course, it's great to be on with John and Bob. I will try and keep up with their wisdom. And I'm looking forward to a great debate. It'll be really fun. I should also say that I'm speaking in a personal capacity, so do not mistake what I'm about to say with the views of the IIF or IIF members. We are calling where we are the data tantrum. We've never had a closing of the economy due to a pandemic the way we did last year. And therefore, we have also never before experienced a reopening of the economy the way we are now. And what that means is that since there's nothing in the data distribution about this thing that is remotely normal, consensus is completely ill-equipped to deal with it. And so we are getting, on the surface, very big surprises, which of course are having some market impact, but really it's just noise. Really, it's just no one has any idea about all the cross currents that are going on in the data, especially in the labor market. I think the cross currents are very significant. And so I think you want to hold true to some underlying views here. So you want to upweight your prior and you want to downweight the data flow. And so what are the priors? The United States, going into this shock, thanks to its exorbitant privilege, had fiscal space far, far beyond anyone else, and it aggressively used that fiscal space. As a result, we think that GDP in the third quarter of this year will actually move slightly above trend. So we're forecasting a very big rebound in GDP. And I'm talking about the trend pre-COVID for GDP. That is unheard of. I mean, it is a proactive policy response, the likes of which we have never seen. It means that we will see a employment picture that's improving rapidly, and it means that in the course of 2022, we will move significantly above what we think is trend GDP, and I'm going to be a little bit careful about using potential. So we will have a positive output gap, meaning GDP above potential, and therefore some upward pressure on trend inflation. The reason that I think all of this matters, and I'm sure we'll get to this in the course of our discussion, is because you want to hold true to the underlying picture. The underlying picture is the United States was extremely proactive in a way that no other country has ever done before, and no other country did in this shock. And so that is giving the US some exceptionalism in terms of the rebound. And so I think we're holding true to that baseline view.
Okay, thank you for that. John, Bob, any additional thoughts, disagreements?
I would add one thing that I would add two things to what Robin just said. One is the data that we have post this great pandemic is flawed. It's noisy. If you had told me that we would lose 22 million jobs and bounce back, the standard deviation on just non-farm payrolls is over 1 million. So if we take into account last Friday's number, it wasn't even it barely was statistically off kilter. And yet, if you read the news and listened to the talking heads and to the Fed themselves, they were shocked. That's very troubling because we have a Federal Reserve that is witnessing what Robin has discussed, which is an extraordinary fiscal response to an extraordinarily horrible event. But their data dependency is at odds with the fact that we don't trust the data and shouldn't. There are base effects, there is dislocation, there are supply shocks, there are demand shocks. And we don't know how this is all going to pan out. So the idea that we can forecast anything but the the idea that the third quarter is going to be above trend, I agree with completely. But the standard deviation of that beat could be much wider and more problematic than we want to admit. The other part that I think is important to take into account is when you look at what the United States did. The US exceptionalism was exceptional on two fronts. One, no other country was as slow to locking down its border. The reaction function of this country to shutting down the economy was horrific. But perhaps because of our willingness to jump into vaccines and really push that as the solution stands out. And that US exceptionalism is becoming more and more clear as when I look at where we are in this country, almost at not yet at herd immunity, but certainly able to have a sigh of relief because we're at 8-month lows in new cases against what's going on in Asia, where zero tolerance for any new case means continually rolling lockdowns and border closings. And that's problematic for globalization in and of itself. And it makes the idea that you can forecast growth globally or domestically problematic because we're still, whether we want to believe it or not, we're not out of the woods with the virus, number one. Number two, the US decided to write checks to consumers. These were actual, as close as you can get to helicopter money in my lifetime. And no one else did that degree of stimulus. All other stimulus were tax credits, loans to corporations. So when you look at the US world, the consumer balance sheet is stronger in the US than most other places. And the corporate balance sheet is leveraged, but the corporate leverage everywhere else is much more troubling.
Good.
I think to this picture,
ahead.
really the only thing I would add, and I agree broadly with everything that's been said, the enormous amount of uncertainty. I mean, broadly, it's credible to think that that the Fed is correct in characterizing the near-term volatility and inflation readings as transient and distorted and so forth. And there's going to be an enormous amount of noise in the data. But as looking out further, not only are the cross currents in the economy and the unprecedented nature of the recovery shrouding our outlook in uncertainty, but also the American jobs plan. The fiscal outlook is something that is an enormous variable here, and we're getting into we've just started the negotiations really in earnest in the White House on Capitol Hill over this plan. The Biden administration doesn't know whether they're going to end up splitting it into a bipartisan, one part bipartisan bill and try to have the more socially focused or more progressive and green initiative pieces in a separate bill that they do through reconciliation. The total number of the package is guess it. The most of the analysts are saying let's split the baby and say one plus trillion is the final number they come out with, but there's certainly low conviction around that. And then even if you were to have a decent level of clarity on what kind of number Congress is going to pass, there's the issue of actually getting that money out the door in an effective way. The federally led infrastructure program in the United States is quite a novel thing. We saw after the global financial crisis, the Obama administration attempt to use infrastructure as something of a stimulus. It was, the results were mixed at best. The ability to translate, it's easy, from Wall Street, and I did this when I was at a hedge fund. You just assume, well, those big numbers go right into the economy. The reality is the project pipeline is relatively thin in a lot of places, and the ability of the federal government to deploy that money in a way that gets spent productively and in the ways that they want it to, that's it's another source of significant uncertainty about the medium to longer term growth outlook. And this is leaving aside the American Families Plan, which is also similarly sized and could have really meaningful economic consequences as well.
Great. Okay, well, let's whip through a bunch of market related questions and then get to the audience. So Powell is being super dovish. He's stressing the Fed's maximum employment mandate. He's noting that inflation is transient and can be accommodated under the flexible average inflation targeting scheme. In this view, the Fed, it was thought, would begin tapering later this year or early next year, according to many. John, you had written about a Jackson Hole announcement. So John, do you buy that view of tapering, and any thought on modalities, and will Powell hold out as long as possible?
Yeah, it really is a very key question. And when we saw, just to roll the tape back to Wednesday, when we saw the elevated consumer price index print that came out, the market reaction, it was characterized in the press as something, it was an inflation scare. The market sold off because of an inflation scare. When you look at the price action, traditional inflation hedges like gold sold off, the dollar spiked, real treasury yields went up, liquidity driven parts of the market fell, Bitcoin was down. It looked, and futures markets pulled forward incrementally expectations for the first Fed rate hike. The price action in response to a big inflation number looked more like a taper tantrum to us. You don't want to give too much credit to one day's trading, but that looked more like a taper tantrum. That suggests that the market is, obviously concerned about inflation, but it's hard to disentangle that from the market's concern about what they think the Fed will do in the face of high inflation. And that really does center around the taper. Speculation, and we've heard it in commentary about whether or not the Fed is going to announce a taper. Jackson Hole is certainly a venue where in the past big policy shifts have been popular, have been pulled out and put on display. Our view is that the Fed is more likely to spend the summer and perhaps Jackson Hole trying to convince the market that they are not going to, in fact, taper. Because one of the problems that they have, the market's not giving them full credit for their dovishness. And that's okay, but you don't want that to go too far if you're the Fed. And, finger in the wind, once they announce a taper, the markets are going to price in the first rate hike about a year after that. And if they're tapering in the second half of this year, that means you're going to get rate hike expectations pulled forward into the second half of 2022, almost automatically, I would think. And I don't think that's where the Fed wants them to be. And so our expectation is that the Fed has a challenging set of communications over the summer, but they hold the line.
So my next question was going to be about the rates, but you've already gone into that. So Bob and Robin, taper rates, do you see it like John?
I think the data will force the Fed to talk about tapering at Jackson Hole. I also think that the Fed has a larger problem than their credibility on inflation, because running it hot is fine, but running it so hot that you burn yourself isn't. So they're going to be forced to define a limit to CPI, whether it's core at 3% for 3 months, which I fully expect us to see, or 4 to 4% for 3 or 4 months, which I also fully expect to see. That's part one. Part two is a much more pressing issue. If you think about where we are, the housing market is completely unfair to the agenda of the Biden administration. Housing costs are going up, wages are not matching it. That inflation is being exacerbated by the Fed buying 40 billion of MBS every month. I fully expect that to be part of the new dialogue of politics in Washington over the summer. This is not uncommon to other central banks. Just have to look at what's going on in New Zealand or in Australia to see other indications that housing, or listen to the speech of our northern friends in Canada. The Bank of Canada yesterday, Macklem, highlighted this unfairness of this recovery. So housing is part of the puzzle and part of the problem that the Fed's buying $40 billion of mortgages every month, inciting a already hot housing market. That's part one. Part two is the Fed's buying 80 billion of treasuries, and every day for the entire month, they've been recycling that excess cash to hold rates at zero. So the reverse repo is necessary for banks to not shove deposits away. Every bank in the United States appears to not want to have cash on hand anymore. We are flooded with the Fed's liquidity. So the emergency measures of the Fed are drowning banks and almost destabilizing the banking industry to a point where you're going to have negative T-bill rates consistently into July. And this is partially because of the plans of the government. The Biden administration is coming up with a political reality that every president has had, which is we have a debt ceiling. And they're going to run down the Treasury cash, the Treasury holdings of debt by stopping T-bill auctions into July and trying to maneuver into the political debate that we always have every 2 to 3 years. And that debt ceiling is going to lead to negative short-term interest rates unless the Fed does something. And it will disrupt lending. It will change. It will actually add fuel to the fire, because right now, anything that you can put money into that has a yield that's close to cash is being grabbed.
Can I weigh in on
Please.
this? Okay, I'm gonna drop the hammer on this discussion. the Fed isn't dovish. I know that that's sort of a consensus view, but operationally speaking and from a market perspective, that's really not the case. So the reason that I say that is take the perspective of the FX market, which all of us have exposure to and worked in. And I have to admit, I've learned most of my FX experience from a certain Mark Sobel. But in the past, in the distant past, the dollar and other major currencies were driven by the 2-year rate differential. But that went out the window when policy rates by the major central banks went to zero and basically stayed at zero over the last decade. And so what matters these days for currencies and by extension for financial conditions and growth are not front-end rates, but the longer end of the yield curve. So the 5-year rate differential, the 10-year rate differential, and even the 30-year differential. So you can see this very nicely in how currencies are responding to different tenors of rate differentials, and it's the long end that is the driver. So what does that mean for the Fed? Obviously, we have average inflation targeting, which is the promise to not raise rates for many years, even if inflation goes up significantly. That's really nothing new. It's the latest iteration of forward guidance, which we had going back as early as basically the last global financial crisis. We had calendar guidance, then we had thresholds, et cetera. And the reason that I don't mean to sound dismissive of forward guidance, but I think essentially the market is pricing that. There are obviously risk premia, depending on data prints. The market will price a little bit more or less in terms of Fed liftoff sooner or later. But I think this is just a risk premium that get priced. What matters for financial conditions and for the effective stance of Fed policy is its view on the long end of the US yield curve. And there I would describe the Fed as agnostic. It is not dovish. At the March 17th FOMC press conference, Steve Leisman, the CNBC anchor, asked Jay Powell, what do you think about the level of the 10-year yield? And the 10-year yield back then was around 1.6%, about the current level. And Jay Powell's answer to that question was, I think financial conditions are highly accommodative. So that was code for, I can't believe that rates are so low. And of course, Treasury Secretary Yellen sort of alluded to this as well recently when she said, well, rates could go somewhat higher. She was obviously talking about longer term rates. So I don't think it's right to characterize the Fed necessarily as dovish. I think the Fed understands that markets may push real rates higher, longer real rates higher, and I think it sort of welcomes that. I think that will be the stabilizer that prevents overheating, and that is a natural source for dollar strength, counter to, Mark, what you have been also highlighting as the consensus, which has been quite dollar bearish.
Okay, well, let's keep moving quickly, but this begs the question of the outlook for the 10-year because a lot of people are projecting 2% at the end of the year. I think, Robin, you've been suggesting it could go higher. We just had this inflation scare, and now the 10-year is back down to 1.6 after not only the inflation scare, but after the passage of the 1.9 billion stimulus. So how do you see? So I guess quick round, starting with John. How do you see the 10-year?
Well, I think that Robin made a great point there that the Fed is agnostic has been agnostic, certainly less forceful in its pushback on the trajectory of the longer dated sovereign yields. The ECB has been much more forceful on it. Certainly the Bank of Japan and Reserve Bank of Australia, just to note a few. But I think that agnosticism may not, as there are no atheists in foxholes, maybe the Fed's agnosticism evaporates. if it's under pressure from the financial markets. And I think that, when our expectation is that over the summer with, we're certainly very sensitive, as Bob says, to the upcoming data that is going to be propulsive, we think, to yields, that the steepening does come back, that actually does lift the dollar up. And we think that there is a point, and whether it's, it's less about level, more about level over a certain period of time. If the 10-year yield is knocking on the door or in trending toward a 2% level by the end of the summer, in the face of the U.S. reopening, beach party summer growth and inflation rebound, then we think that the Fed will be joining some of its global peers in a more serious rhetorical pushback on that tightening of financial conditions. And we think that rhetorical pushback will take the form of redoubled commitment to QE. So that's certainly where Bob and I differ.
Yeah, I think something interesting happened in the first quarter that we're underestimating, which is, I don't disagree with either you, John, or Robin, about the idea that the Fed is agnostic about the long end rate, as long as it is not impacting financial conditions and doesn't show that it is impeding the recovery that they so desperately want to fill the gap, whether it's labor or, now they've filled the inflation gap, perhaps not the inflation gap that they want, which is wage inflation, right? The issue is about portfolio management and risk. For the last 10 years, the government has allowed the Fed to basically manipulate the Treasury market. And at the beginning of the year, there was a big discussion that the Fed would be forced into yield curve control. And the question that neither of you really noted was, at what level would they even reconsider that, right? When does yield curve control matter again? Would be that we're not growing at expectations and that yields are at 2.5% in the 10-year. And at 0 to 2.5% curve, 0 to 10 years would be extraordinary and probably would make financial conditions a little too tight. The dollar should logically go up because of that. And it probably means that our exporters suffer a little bit. What they don't see and what doesn't add up in this picture is that 2.5% 10-year yields look attractive to many corporations, and the yield that was being given by their dividends. And with valuations in the stock market being where they are, the stock market is a variable to the Fed that no one really wants to talk about. But if the stock market went from its present PE ratio to something that would be normal, then I think you would probably see the Fed change its tune about financial conditions. So I hear what both of you are saying, and I kind of agree with it. But the rail that we all learned from 2008 was that there are 3 mandates to the Fed: jobs, stable prices, and the stock market has to be stable as well, because we're all now dependent upon the 401k.
Good. You guys are not disappointing me. You have plenty of debates amongst yourselves. Let me throw out maybe a last question, and then hopefully the audience will begin submitting lots of questions. It's a broad one. It's basically, how do you see the dollar, first of all, versus the majors, secondly, versus EM, and Robin, I'd really appreciate it in a discussion of the dollar outlook if you had any pithy thoughts for us on the European Central Bank and its monetary policies. Who wants to go first for this one? Robin, I'm gonna, not Bob.
I'll jump in. Look, I think there are many different, I hate the term the dollar because the dollar is 85% of the market, but there's many different arrangements. And Mark, I think you correctly said there are only $2 that really matter: the relationship of the dollar to China and to Mexico / maybe a little Canada. And then in that front, the dollar's pretty darn stable, excluding Canada, where it's had a bout of weakness that I think can be explained by commodity, not energy commodities, but all the other ones like lumber, which has tripled in value since December. So Canada suggests that there is something wrong with the U.S. relationship. But I think the larger issue for the dollar is about the broken globalization in trade. And so the center of this debate that I think you're setting up is, are real rates in the US attractive enough compared to everybody else's? And when it comes to emerging markets, the answer has been yes. Brazil's real rates were ridiculously low to the history of that country. The central bank has changed its tune. Brazil begins to see the real strengthen a little bit, right? So I think that real rates as a differentiator of dollar value begin to matter. And so the debate that we were having about where the Fed sees 10-year rates begins to start to bite, as much as it's de-anchoring of the inflation rate for consumer expectations, right? So, at 4.3% University of Michigan 12-month views on inflation, I think the Fed will begin to pay a little of attention to that and want U.S. rates to be a little bit more, frothy compared to their cousins in the stock market. The dollar against the alternatives to reserves, there is no alternative. The Chinese are not yet in the club of freely floating currency. You can't buy anything there without constraint. So let's not even talk about that. And we won't go into the digital yuan and payments. What we will talk about is the euro. And I think the euro has a fighting chance to compete with the dollar, should the Fed sound more dovish than Robin thinks they are, should the ECB sound more hawkish than they've acted, right? There is a chance that in June, the ECB reverts to a more traditional German approach. And the euro is the only alternative to the dollar. And then on the edges, the federalization of Europe could actually occur out of this crisis should the Green Party take a larger role in German politics. They could be the leader for a more dramatic change to a more mutualized debt situation for all of Europe. And that alone would mean that the euro would gain something against the dollar.
Well, I have no doubts that such a comment will elicit a reaction from Robin.
Challenge accepted. So I am guilty as an economist and a strategist for thinking too much in terms of where things should be as opposed to necessarily where they will be. And it means that periodically I fall flat on my face when the market disagrees. But let me answer the dollar question and also the Euro ECB question through the lens of real rates, which Bob just mentioned. So the real 10-year rate in the United States is around minus 0.8%. At the absolute peak of the COVID shock last year, we were around -1. So we are essentially at extremely accommodative financial conditions, even as the economy is reopening, we are returning to the status quo ex ante, and we have a lot more debt. So do I think that real rates at these levels are justified? No, of course they're not. And my target for the nominal 10-year yield by the end of the year is 2.5%, which I think is the level that prevailed before recession fears took over in the second half of 2019. That was before COVID came along. That was about a manufacturing scare and markets inverting the yield curve at that time because of those fears. So I think that's where we're going. And I think that sets us up, given what I was saying about the longer tenor of rate differentials mattering for FX, for a stronger dollar. Now, I have given up hope. They say hope dies last. In my case, it's died pretty much. That euro will ever go to parity and below parity, as I had once forecast. So the question, why is that? And I think we're getting a great lens on that now. If you look at longer term European rates, they're rising 1 for 1, if not more, with long-term US rates. So rate differentials for euro dollar have basically been flat, if not slightly euro positive. And so John is right that the ECB is talking a lot about yields. It's just that it has very low credibility with the market, unlike the Fed, and the market really doesn't give it much weight. And so my view on G10FX is basically, in particular, the majors will get range trading, and I think euro is basically a non-story. I think rising real rates in the United States for EM are a huge story. And the big imbalance that we have globally is we have fiscally constrained emerging markets that were not able to spend much, that suffered crushing recessions. Take Mexico, right? The GDP last year fell 10% basically. Had very little fiscal space to buffer that. Now real rates in the United States are way too low. We've done huge fiscal expansion. And so we are cyclically completely out of sync with emerging markets, and real rates need to rise. So that's a big issue for emerging market currencies versus the dollar, and is a source of depreciation pressure on EM versus the dollar. And I think we're seeing some of the canaries in the coal mine already react. So Turkish lira has been quite weak. Brazil has suffered. Colombia has suffered. So some of the higher beta currencies in EM have been responding to that.
Just my views on the dollar are not particularly differentiated from what we've talked about. The Robin's range trading expectation is not far off from our own, and certainly in the near term, we see real yields going up and leading to a bit of a dollar rebound. Although the Fed, we do see the Fed trying to push back against it with some degree of success in the second half of the year. We are very intrigued. I'm very intrigued by what's going on in Europe, and the idea of as Chancellor Merkel leaves the stage, we've obviously seen the COVID crisis have that galvanizing effect on Europe in terms of the increased degree of fiscal federalism that they're set to allow, and perhaps the pole of power shifting south with Prime Minister Draghi in Italy, taking the opportunity of his first major speech to talk about how a pan-European emergency fund is needed. These are all, steps in the direction that Bob was alluding to as well. The potential for, the Green Party in Germany to be aligned more with that directionality, and to have the ECB, in some ways, I think, be a, more of a facilitator of fiscal budgets and fiscal expenditure, rather than the old formulation, which we saw in the US in the post-global financial crisis sort of thinking as well, is the more we do on the fiscal front, the less we have to do on the monetary front. And I think that formulation is being obviously morphed and evolving in a lot of different cases. And so the explicitness with which, whether the degree to which they're credible, I agree with Robin, is a bit debatable, but the explicitness with which the ECB has come out and pushed back on the markets and allowed, in the case of Italy, certainly facilitating greater fiscal aggression from Mario Draghi and his political push there. I think that potentially changes the dynamic, and our view is that is, on balance, actually over time, it strengthens the euro. It's a more positive viewpoint. one of the big Achilles heels of the European project has been that lack of fiscal federalism, and that's proven to be so problematic in the past. So we think that that's going to be over the long period of time, something that allows the euro to to keep up with even in the cases of U.S. economic outperformance. And broadly speaking, we still see major central banks engaging in mirroring behavior, and where they all look at each other before they kind of do anything, and stability of currencies is more prevalent than as a goal than particular directionality or level.
Well, thank you for that. I'd make one observation about the euro, which is that it never struck me that the Europeans want a appreciating currency, and that certainly has implications for the euro's ability longer term to grow and rise in global share, but I could be proven quite wrong on that. But certainly one of the reasons the dollar is able to play a reserve role is that we kind of do just let the currency float, and we're willing to be the importer for the world within certain limits. I think George's questions involved financial stability risks, SPACs, crypto, Covenant Light, Robinhood. Are these one-offs or part of a larger picture? And if the 10-year sells off violently, where do you see the greatest vulnerability?
I'll jump in on, we talked a little bit about financial stability and financial conditions and the role that the Fed has in being responsible for regulating some of that excess. Although, the United States government has long arms about, whether it's the SEC or the CFTC, there are many people involved in being held responsible for this financial stability. And I do think that there is a common ground that marks a notable difference between this recovery and the recovery we just had. And that in and of itself is a part of the problem, which is we are now living in a world where we expect the Fed to be able to extend the business cycle indefinitely through smart policy. And yet much of this is driven by financial policy, government policy, now more than monetary policy. And as we have seen the excesses of the market in doubt about the dollar stability and about perhaps the Fed's real rate appetite, money looks for stability. And I went on a rant before about how much money the Fed is soaking up in reverse repos on overnight. It was over $250 billion yesterday. If you have something that has a pretense that it's a better alternative than zero, it's going to go to it. So there is the reason why covenant light loans and crypto markets and SPACs have become part of our parlance is partially because we've had emergency policy well through the time that most cycles would allow it, but we don't believe the output gap story as much as we did anymore. And I think that the biggest problem that we have for financial stability is that the last playbook was the 2008 10 years to fill all of the crisis back versus the traditional, you have three good years and a year and a half of pain, and then you go back to another business cycle. And we're not used to that world, and that yet might be where we are.
Yeah, just in terms of financial stability, the point that I would make is we've seen some of the most bubblicious and frothy parts of the market really take a beating over the last couple of months. And whether it's SPACs, whether it's the ARK Innovation ETF, Tesla, these are down a lot. Crypto is off. You know, Elon Musk is the puppet master this week of the cryptocurrency complex. But these are, you know, many of these coins, Bitcoin, are well off their highs. This sort of, we've joked that from the policymaker perspective, what we've seen is the immaculate correction. You know, if you're looking for what you would want to see in financial markets, if you're sitting in Treasury or the Fed, is you would want to see these pockets of excess begin to deflate, and things that are more attached to the real economy, whether it's Dow transports or whether it's commodity prices. You know, there's a point to which you wouldn't want commodity prices to go, obviously, but indications in the market that the real economy is coming back, that's certainly something that that policymakers would favor. And you know, I think that financial stability, as the Biden administration sort of rounds out its team and gets its personnel and resources arrayed to confront some of these problems, you know, we had a real live fire stress test for the banking system. You know, obviously the Fed and stimulus came in, but you know, in this the pandemic, it's easy to see how that could have become a banking crisis quite quickly. And the banks performed admirably. And so I think from the regulatory standpoint, they're not going to put up a mission accomplished banner, but I think, you know, and they're not going to say it publicly, but I would bet that, you know, in FSOC, they think, you know, hey, we did a pretty good job. Bank stability looks pretty good here. Now let's focus on where the pockets of risk are. And it's non-bank financials. It's the Archegos. It's the hidden leverage in the system. That was a discussion that was going on back in the Obama administration. They were looking to hand that off to the, you know, incoming Clinton administration to follow through on. It wasn't necessarily, didn't work out that way. But we think that that is going to be a significant line of inquiry for regulators.
Thank you for that. There are a few questions in from Vinit Sharma of Accenture, but he had a particularly interesting question about financial conditions and the Biden administration's priorities. Vinit, would you like to just pose that question quickly for us? Please go ahead.
Yeah. In fact, I have a question regarding, regarding this inflation being transitory, at this point of time. But some of the experts like Larry Summers and in fact, others have, pointed out that the inflation is likely to be much more long term, and it could go above 10%, and it could go up into the 1970s or 80s range. So what will be the impact of that? And my second question is regarding Biden administration's viewpoint, because they are very much, focused at this point of time on infrastructure, social issues, like on social spending, on global taxation, and on education, etc. But at this point of time, it seems that their focus might be somewhat, distracted because of this, some of the headwinds that we are seeing at this point of time because of this inflation and some of these issues, some of these challenges that are coming up, and because of this overheated condition, and that might be some kind of a distraction for them. So how do you view that at this point of time, that this government, that the Treasury Department and this Fed will be able to manage all these distractions and will be able to stabilize the financial conditions?
Great. So will the financial conditions disrupt all the Treasury and Biden administration priorities on climate, infrastructure, and the like?
So let me take a stab at that. This crisis has brought about a rethink on debt and debt sustainability. And we today consider debt levels sustainable that in the past probably would send people screaming for the door. The argument for why these debt levels are sustainable now, when they were considered unsustainable in the past, is that interest rates are low. that's where you enter the hall of mirrors and endless circularity, because we set those interest rates. So it's a completely nonsensical argument. Um, and
Even
I
in
am
an
not,
R-star world?
well, our star, oh, come on, Mark, now you're just baiting me. So let me come back to that. So the argument for much higher levels of debt being sustainable is really also an argument that interest rates have to stay low. Maybe they stay low for a reason because of R star. Maybe they stay low because of fiscal dominance. We don't know. But one way or another, I think clearly the level of debt has a risk that it's going to influence our view on interest rates. And I think, Bob, you mentioned YCC earlier, so potentially those channels are open. If inflation really does pick up, and the main counterpoint to a big pickup in inflation is that inflation has been very low for very long, then I think this whole construct will be challenged. And what I can say now this year, Mark, you've mentioned a couple times the CPI print that was hotter than people were expecting. We do think that in 2021, the disruptions to supply are much longer lasting and much more severe than people think. And there's still a lot of pass-through, we think, into CPI and core PCE that's coming. And so from a policymaker point of view, it's going to be really, really hard this year to tell apart demand versus supply dynamics in prices. And it'll be very hard to communicate that to markets. Now on R star, Mark, as you know, I'm not a big fan of output gaps, which are a trend around GDP. R star is a trend around actual interest rates. It is equally problematic. And in the original Laubach-Williams paper, there's a number of omitted variables which bias the estimate for R star down, most obviously the dollar and oil prices, which are not in their framework. So I'm a little bit skeptical about so, output gaps, the way that they have been used essentially are a justification for the status quo. And I worry a great deal that R star really is kind of the same thing.
I'll jump in there. Let's be clear. Climate change issues and the greening of politics is an important trend. And the Biden administration clearly has a large contingent of believers in that process, and they should. The rest of the world's doing that. Green bonds are going to be one of the reasons why the euro is going to surprise all of you, because they're issuing that debt and people are going to need to buy it, because investors, particularly those that are younger than all of us white guys that are looking a little tired, are going to demand it. So that's part one. Unless Biden comes up with a way to match the Europeans' effort to green the issuance of bonds but from the Treasury, we've lost a little bit of finesse there. Now, part two, I would argue that the financial constraints of debt are real, and that the role of public-private partnerships in this country are the only hope for him to get a wiggle through to what otherwise seems like a non-starter, because most people in this country don't believe that the state can really do much better than Amtrak. And I know he loves Amtrak, but they would rather drive. And so the point of that commentary is that there's a lot more work that Biden has to do to convince the American public that the green agenda can just rest on the laurels of the public sector tinkering on the edges. And then let's go to the reality of him shutting down new drilling on public land and the effect that it had on oil prices, or shutting down the pipeline, the Keystone Pipeline, which is controversial and maybe not a bad idea. But these have immediate impacts on US energy independence, the value of the dollar in its balance of payments, and the relationship. So the role of oil was becoming less important to the dollar, and the way that the debt dynamic of the US worked. And by tinkering on the edges, as he might well logically be doing, it's led to a support to OPEC Plus controlling the oil price in a more dramatic way. And I think we're going to have a lot of volatility in oil until we eventually all are driving electric cars and running on wind and solar and some other geothermal nirvana. That's that to me is his conundrum. And you can't get it done in 4 years. You can't get it done in 8 years.
Yep. So we have like 2 minutes, 3 minutes left. So I want to semi-bait Robin now. RMB, we haven't talked about that. I think you see it as substantially undervalued with a heavy focus, based upon a heavy focus on the trade balance. Others focus on the current account, see the current account up due to pandemic related reasons, but see it basically slight surplus. RMB has risen a good bit in the markets, trade weighted basis and against the dollar last year. Just how do you see it, and how do you respond to those of us who think that the 10% undervaluation estimate may be a bit too much?
So first off, China played a big role in the last big global crisis we had. In the global financial crisis, China did a very, very big infrastructure stimulus in 2009. And that played a huge role in helping global demand come back and was massively helpful to emerging markets. China is not doing that this time around, hasn't done it. There are no plans to do it. And that means that the global demand imbalance that I was describing, where the US debt expansion is fueling consumption here, but not the same kind of EM-friendly recovery, because this US debt expansion comes with higher interest rates, that's a big challenge for emerging markets. So China is playing a very, very big role in the global recovery. And it's the lack of stimulus that's really notable this time around. The undervaluation of the RMB is really a legacy issue, and it dates back many years. Remember, a couple of years ago, people were talking about China's current account going to zero and maybe even going into deficit. And that reading was based on in my view, that this was a misinterpretation of what was going on. And in particular, one of the key drivers in the current account, which gave that impression, was the services balance, which was increasingly going into deficit. And so that was tourism. Chinese were able to travel more, and it was capital flight. None of which are a signal for FX valuation. And I think this is really important. When we think about real exchange rates and whether they are in equilibrium, what we should look at first and foremost is goods trade, because that's where we can pin down the elasticities most obviously. And the services balance for China, basically, in my view, is sort of a structural break story. You had an opening up that allowed people to travel out, and then you had devaluation fears, which accelerated that services balance deterioration because people used their travel outside of China to hit the ATM. And so when we abstract from that, the current account or the underlying trade balance that I spend a lot of time talking about That's basically in dollar terms at the same magnitude as it was at the peak in 2011, 2012. So there has been now no adjustment. Now, the obvious pushback to that is that you should scale this number by GDP. And the question, I think, is, well, how much weight should you put on the denominator versus the numerator? And I place a lot of weight on the numerator because I do think it captures these elasticity effects and whether or not the exchange rate has done enough work. I think here, so what I just outlined was sort of a legacy argument. I think there was a misunderstanding of the current account data. But most importantly here, I can totally understand that China doesn't want to repeat the 2009 stimulus. It ran up a lot of debt and it has a debt overhang of its own. But I think to help the global economy, an appreciation of the RMB would be phenomenal. It would be basically a transfer of demand from China to the rest of the world, and that would be great. It would really help emerging markets recover and offset some of the drag that they're going to get from rising US interest rates. So in terms of, I think there are many compelling arguments, and some of those are in China's interest as well.
I don't disagree with Robin's points at all, excluding a couple of things that I think really motivate the leadership in China, which is the number one issue for them is jobs. And the number two issue is getting the growth targets that they have to really balance the economy so that those jobs are well paying, right? So there is some logic to the idea that a stronger renminbi allows the consumer in China to feel wealthier and spend more. The counterpoint to all of this is that growth in China has been linked to its population. And the real issue for them is that they're in the same boat, just a decade behind Japan, Korea, and that they aren't where they should be on moving out of the middle class trap. They need to really become technological giants to compete. And that really makes this competition between the US and China more important to the value of that currency than it probably should be. But I think in the very short term, the fact that the Sinovac vaccine and all the PPE in the world was delivered over the last year puts them in a little bit of a bad spot for 2022 growth. And I do think that their policy mix is not helping the consumer right now. So the only place the Chinese feel comfortable putting money is either the stock market when they tell them it's okay, they're buying of real estate, or they're buying of commodities. And what's being told to them is you don't buy real estate, don't buy commodities. So unless the stock market really roars, the renminbi is overvalued to that pressure that they have to own something else.
The place where we get most of our questions about China from our clients and from basically from commentators around the world is, when's the Biden administration going to roll back the Trump posture toward China? And our answer is they're not. This is the degree to which the consensus on China has changed in Washington, D.C. is astonishing. And it really goes back to basically the abolishment of President Xi's term limit. That was the moment that the convergenists, the converging thesis basically lost the argument right there. That was based on the idea that the richer China gets, the more like us they're going to become, the more they're going to internalize the global value system and be a responsible player on the world stage. And that was basically it for that argument. There is no constituency in Washington for rolling back the U.S. Prohibitions against Chinese 5G. That is now a national security issue. the reshoring of supply lines from PPE to, you name it, anything that was coming through China, the expansive understanding of what is strategic, of strategic importance to the United States is growing ever by the day. And the balkanization of our economies is what we see that as a process that is basically going in one direction. And there's, whether it's, Chinese companies listed in the United States, we get a lot of, our clients on Wall Street saying, well, they can't really like delist Chinese companies if they aren't disclosing. Look what happened to Alibaba over the last 6 months, right? The Chinese are making the case for U.S. regulators. I mean, you can't make a better case than that. That, highlighting one of your best companies has no enforceable property rights in its own market, its home market, and can be treated in a way that is injurious to U.S. to U.S. investors. And so, we think that the multi-front U.S. campaign to counter China's ambitions on the global stage is changing under the Biden administration only by prioritization and emphasis and style. And when the Trump administration was in there doing a lot of it, a lot of the Democrats who were on the sidelines were saying, that's what we should be doing. But they're just, we're going to do it in a different way. And I think that it's a dynamic that is going to be extremely consequential over the coming years.
Great. Well, John, you just had the last word. We've run considerably over time, but we probably could go on for hours, but people have real jobs to go on to for the rest of the day. So I thank the three of you for a fascinating, lively discussion. Thanks to Bob Savage, John Fagan, Robin Brooks. Have a good day.